Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at UiPath.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. The core story for UiPath right now is a truly fascinating one. It's all about a transition.
A transition. Okay, I think I know where you're going with this.
For years, they were the classic, high-gross, cash-burning tech company.
Right, the model we've seen 1,000 times, grow at all costs.
Exactly. But now we're watching them evolve into a maturing cash-generative SaaS platform.
And that changes the entire investment thesis.
Fundamentally.
Okay, let's unpack that. We've known them for their automation tools, for RPA, but what's the big concrete change we're seeing in their financials?
The biggest thing is the decisive turnaround in profitability and cash flow. This is the inflection point everyone was waiting for.
The proof that the model actually works at scale.
Precisely. They just achieved their very first GAAP profitable quarter.
Their first. Wow. Okay, so for anyone listening, why is GAAP profitability so much more important than, say, the non-GAAP numbers we always hear about?
Well, non-GAAP often smooths out big expenses, like stock-based compensation, which is huge in tech.
It paints a rosier picture.
It can. But GAAP, that's the true picture of operational health. It means after accounting for all expenses, they still made money.
What were the numbers?
They reported $13 million in GAAP operating income, and alongside that, a strong $88 million in non-GAAP.
So that GAAP profit is what really separates them. It moves them into a different league. What did that mean for earnings?
That performance led to an EPS of 16 cents, which beat analyst expectations of 14 cents.
That's a solid beat.
It is, but I'd look even deeper. The operating cash flow, the OCF, already turned positive a while back. And that's arguably a more reliable long-term signal.
Right, the actual cash cycling through the business. What did that look like?
Over a recent 9-month period, they generated about $174.5 million in net cash from operations.
And was that growing?
Yep, up 14% year over year.
Yeah.
And that tells you the model is really scaling. They can now fund their own growth.
Okay, this is where it gets really interesting then. Positive cash flow and now GAAP profitability, it suggests the underlying business isn't just a growth story anymore.
It's a sustainable business, a healthy one.
Exactly.
And if you look at where that's coming from, their main revenue driver is accelerating.
Subscription revenue.
Subscription revenue. It pushed their annual recurring revenue, or ARR, up to $1.782 billion.
And that's an 11% year-over-year increase.
11% increase, yeah.
That recurring revenue is the golden ticket in the SaaS world. But growth like that, it often comes at a price. How are their margins holding up?
They're not just holding up, they're expanding, which is what's so impressive. They recently hit 83% on gross margin.
83%. Wow, in software, that's exceptional.
It's top tier. It shows you their unit economics are just incredible. The cost to serve each new customer is tiny compared to the revenue they bring in.
And that creates incredible operating leverage as they scale. What about overhead? G&A costs and all that?
Also improving. General and administrative expenses actually declined as a percentage of revenue.
From what to what?
From 19% down to 18%. It's a small drop, but it demonstrates real discipline. They're getting bigger without getting bloated.
That shows discipline management. Okay, so speaking of management, what are they doing with all this new cash?
They're putting it to work, which signals a lot of confidence.
How so?
First, the balance sheet is a fortress. Low debt, tons of cash. They even generated over $37 million in interest income in 9 months.
That's a nice little bonus. But what about capital allocation?
They're actively buying back stock. We saw them execute repurchases at an average price of around $12.43 back in October.
Which is a very direct signal, right? Management is basically saying, we think our stock is a bargain at this price.
Exactly. They're putting their money where their mouth is. And they still have a lot of firepower left.
How much?
Over $516 million is still authorized for future buybacks.
Okay, so the fundamentals are strong, management is confident. Let's talk about their competitive standing. Automation is a crowded space. What protects UiPath? What's their moat?
Their moat is definitely deepening, especially with how they're integrating AI.
Okay.
It's really two things: platform lock-in and that advanced AI, their proprietary tech, creates huge switching costs. Once a company builds its critical workflows on UiPath, it's incredibly difficult and risky to rip it all out.
I've been hearing a lot about agentic automation. How does that fit in? Is that the next big thing for them?
That's the key. Agentic automation is what moves them from just being a tool to being more like an operating system for enterprise automation.
Mm.
It uses AI, machine learning, NLP, all of it, to create automation that can genuinely emulate human decision-making.
So it's not just copying and pasting from one field to another anymore.
Not at all. Think about an insurance claim. Old RPA could pull the name and the date. Agentic automation can read the unstructured notes, decide if a clause applies based on context, summarize a legal doc, and then route it to the right person. It's making smart decisions.
That's a huge leap in capability, and that's what protects them against, say, the big cloud players who are all getting into this space.
It's a huge part of it. But their other defense is partnerships.
Yeah.
They're not trying to fight everyone. They're integrated.
Who are the key partners?
They have critical partnerships with OpenAI and NVIDIA for the AI side of things, and deep integrations with systems like Microsoft Azure and Snowflake.
So instead of competing head-on with Microsoft, they're embedding themselves into that ecosystem.
Precisely. It makes them essential. And then you have the macro tailwinds.
A push for AI everywhere.
Yes, enterprise spending on automation is still really high. But more importantly, automation is seen as a cost reduction tool. So even if the economy slows down, companies will still invest in it to drive efficiency. It's almost defensive.
Okay, let's pivot to the charts. The market is clearly reacting to this shift in their story.
It is, yeah. The recent financial beats have translated directly into momentum. The stock surged 7.8% recently on really heavy volume.
So from a technical perspective, what are the key levels people should be watching?
The setup is showing bullish accumulation. You've got key support at the 50-day moving average, around $15.53.
Now the 200-day.
Is further down at $12.91. But what's really interesting is the potential for what traders call a golden cross.
Can you explain that quickly?
Sure. It's a bullish signal. It's when the short-term 50-day average crosses above the long-term 200-day average. It often signals the start of a new, sustained uptrend.
And the stock isn't overbought yet. There's still room to run.
Not at all, according to the RSI.
Yeah.
The relative strength index is neutral, around 39.74. It suggests there's plenty of room for upside before things get overheated.
Okay, that's the bull case, and it's a compelling one. But we have to look at the other side. What are the major risks? The red flags.
Absolutely. The primary concerns right now, I'd say, revolve around insider sentiment.
You mean insider selling?
Yeah, there have been clusters of selling. About 2.1 million shares over the last 90 days from the CEO, the CFO, the CAO.
That sounds like a lot. Is it a reason to panic?
Not necessarily. It's important to know that most of this is done under pre-scheduled 10b5-1 selling plans.
So these are sales that were planned out months in advance to let executives cash out some of their stock without being accused of insider trading.
Exactly. It's standard practice. But, when you see a cluster of sales, even if they are planned, it can still put some pressure on sentiment in the short term. It's something to be aware of.
Any other risks?
There's been some noise about legal scrutiny over fiduciary duties, which created a bit of volatility. But honestly, the profitability news and the upcoming catalysts seem to be overpowering those concerns for now.
Okay, let's talk about those catalysts. Looking ahead, what are the immediate events that could really move the stock?
There are two big ones on the calendar. The first is their inclusion in the S&P Midcap 400 index.
Index inclusion is always a powerful tailwind, isn't it?
It's a mechanical one. It drives passive inflows. All the index funds that track the Midcap 400 have to buy the stock. It forces buying pressure.
And what's the second catalyst?
Their next earnings report, Q4 fiscal 26, which should be around February or March.
And that'll be critical to prove this wasn't just a one-off profitable quarter.
That's the one. Investors will be laser-focused on seeing if that gap profitability continues and, of course, what their guidance looks like for the year ahead.
So the thesis really centers on this undeniable profitability shift, this agentic AI platform deepening their moat. And then you have the technical tailwinds and index inclusion driving a potential re-rating.
That's a perfect summary. What's so fascinating here is that UiPath is moving beyond being just an RPA tool. It's becoming a core enterprise automation operating system. And that new floor of profitability just fundamentally changes the valuation narrative.
It really does. If you found our analysis useful and want more insights on companies hitting these major inflection points, please subscribe and join us for the next one. We appreciate your support.